Hey everybody, welcome back to the channel. We are back on another episode of the Daily Recap. Happy to be back. Over the past 2 weeks, we have earnings season, and realistically, I think every quarter we're likely not going to be able to do a daily recap during earnings season because we're doing the stream until like 8 p.m. every day. I think at 1.2 weeks ago, we had like a 9-hour stream. So usually when we get into earnings season, which is 4 times a year, you should expect probably a 1 to 2 week delay on the daily recaps. But earnings season is pretty much done. We have some more earnings throughout the next couple of weeks that we'll talk about. I had Rocket Lab, ASTS, CoreWeave today, a bunch of those companies. Nvidia is the next big catalyst on November 19th. So pretty much after you get done with big tech, and then we had Palantir and Robinhood last week that were also really important. You are done for earnings season. And so we're going to see what happens with Nvidia, but we are back. Got a lot to talk about. A lot has happened over the past 2 weeks. I want to catch everybody up to speed. First of all, government shutdown. We got to talk about it. Looks like it's over, and it seems like that's why the market might be up today. S&P was up 1.5%. Really good day for the S&P, only 1% away from all-time highs. Nvidia had its best day since April, which you might not think about given Nvidia was at 212, then it came all the way down to 160 or 178 last week. Now back up to 199 today. You might not have thought it was the best day since April, but it was the best day since April of 5.8% for Nvidia. So we'll talk about the shutdown. We will talk about this AI bearish bet that Michael Burry has taken and kind of my thoughts and what's going on in regards to how Burry is thinking of the broader bearish trade around CapEx, data centers, AI in general. We'll talk about that. And then, well, we got to talk about Trump stimulus because maybe, just maybe, we might be getting some stimmy checks. Let's get into it. Okay, so let's get started with the shutdown news. Basically, what has been happening over the past 40 days that the Democrats and Republicans in the United States of America, which comprise the 2 major political parties in the House and the Senate, which comprise Congress, they could not come to an agreement on what to do in regards to funding the government. The number one reason for why they could not come to an agreement was if they wanted to extend ACA subsidies, this is the Affordable Care Act, which was passed underneath the Obama administration, to illegal immigrants. The Republicans are saying we don't want to fund illegal immigrants' healthcare. The Democrats are saying this is an essential right that people have and you can't take it away. And that got the government shut down for the past 40 days. Yesterday, the Senate, which needs 60 votes to pass something, got 8 Democrats to agree with 52 Republicans to end the shutdown and not necessarily fund the government for the next year, but fund the government until January 30th. So it's very important for people to understand that we might be back on this essentially game that the Democrats and Republicans are playing with the entire United States, the entire country. You have a lot of people that have been furloughed, a lot of people that have not been able to have pay for the past couple of weeks. This game is going to continue in January if there is not a resolution around the healthcare portion, which potentially is going to get a vote in December. That's why you had stocks like Oscar take a big dip today. Oscar's entire business model is rooted in these healthcare ACA subsidies. It's not the only thing that matters, but it's definitely a big part of their business. That's down 15% of the day because we don't have any clarity on this. And so last night, the Senate passed the first stage of a deal that would end the U.S. government shutdown, which began again on October 1st. Likely tomorrow or Wednesday, we're going to get an overall vote in the House now that the procedural vote has passed the Senate by getting those 8 Democratic senators to vote on it. And that will put in place the ability for us to end the shutdown. I think the most important thing to understand about this shutdown is that last Friday, we had a really ugly day in the stock market. I mean, the S&P 500 was down about 1.2%. At one point at 1 p.m., things just got very ugly. I would imagine a lot of people's portfolios were taking a pretty ugly hit. Then by 2 o'clock, things started reversing. And I was actually doing a podcast at the time, and I looked over to my phone and I was like, wow, we are potentially about to go green. And one of the reasons we were about to go green is because there was a headline that Democrats are ready to negotiate with Republicans on ending the shutdown. And it's almost like you have all these different arguments for why the market was down last week. Last week was a very emotional, choppy week. You could point to the labor market, worst layoffs that we had since 2003. You could point to the lack of governmental data because the government was shut down. You could point to hiccups in the AI CapEx trade with all this debt that's being issued to finance data centers that we'll talk about in a second. Apparently, based on the price action on Friday, which ended green, and the after hours was really green on Friday, and then today up 1.5%, Nvidia having the best day since April, it's almost like the entire market, the algos, everything that's in there cared about the shutdown. And now that the shutdown is over, it's almost like we potentially have the ability to make the next leg up, given that we took such a steep haircut last week. I mean, we were almost pushing below 660, and now we're back at 681. So if you bought the dip last week, congrats. If you took advantage of all these different opportunities, obviously dip buyers have been very resilient in this market and things have worked out. It's just astonishing to me to see that the shutdown, which no one cared about, the market definitely didn't care about it for the past 30 days, decided on Friday it really cared about it. And as of the price action today, you're seeing that now that the shutdown is basically over, markets are ready to go back higher again, hopefully, as earnings growth continues. So we had a good big tech earnings. You had really good results from Palantir and Robinhood. Talked about that on Twitter, put out some videos about it. We put out our raw thoughts on Palantir's earnings after it came out. And so obviously, those results were phenomenal. We got Nvidia left. Seems like we need to end the shutdown. Now that the shutdown's over, maybe that helps the S&P 500 get back to all-time highs. All right, let's talk about Burry. Now, the other big thing in terms of the piece of news that we had last week that I didn't get a chance to talk about on the daily recap is that Michael Burry is officially having a put position against Nvidia and Palantir. Now, there's a lot of nuance to this, and I want to kind of break it down, but there's a $1 billion notional bet that Michael Burry has. That doesn't mean he paid $1 billion, but that means the notional value of his puts are $1 billion, and same thing for, Nvidia is about $187 million. That is a bearish bet against Palantir and Nvidia. Is he shorting those companies? We don't exactly know. Are they just puts? We don't exactly know. Quite frankly, based on some of his cryptic tweets, which he tends to be a prolific poster that is more mysterious than not and tends to be a bit more cryptic. Reminds me of the movie Catch Me If You Can, kind of the way that he gives out hints. Classic movie, by the way, Leo DiCaprio, an amazing movie. It's almost like he might be out of the position, right? I read some reports today that he's completely out of the position, and technically you don't get to know about that for the next 45 days until the next 13Fs and 13Gs are disclosed. By the way, we're going to get a lot of institutional ownership disclosed this week, so definitely we'll be keeping people up to date on different changes in these super investor portfolios. But at its core, no one fully knows if he is short, net short, puts, or completely out of the position. What we do know is that these puts were initiated or had to be initiated based on the date of filing by the end of September 30th, 2025. The lowest price Palantir got to in that quarter was 142. I really doubt that he started shorting. Well, I'll just say shorting for lack of a better word. It might not be actually shorting Palantir at 142. And if he did, he's really underwater. I doubt he got the 190s, which were sort of the highs of that quarter. We barely touched it for a second. Then we got more to the 190s in October. That's when we actually started to get into the 200s. I doubt he got the top. I also doubt he got the bottom. So at some level, I think realistically, he probably started shorting Palantir around 175 to 185. Well, given the rebound that Palantir had today, even after this disclosure came out, Palantir is trading at $194.18 right now. I mean, there's an argument that he is underwater on these puts. There's also an argument that he already got out of the position last week. Alex Karp, the CEO of the company, made some headlines last week by basically saying he thinks it's market manipulation. And essentially, Michael Burry, and this is hard to sort of argue with. He disclosed this 13F for the first time in a decade, which is the SEC form that's required to show what positions you have if you are managing capital, 2 weeks early. He never does that. He hasn't done that for the past decade. He did that this time. Why did he do that? Maybe he wanted to bring some attention to create some manipulation so he could get the hell out of his position because he saw those earnings results and 63% revenue growth and 51% adjusted operating margins probably is not something you want to mess around with in terms of being short or have a net put position. So I don't fully know what Michael Burry's doing. Same thing with Nvidia. I don't think it makes a lot of sense shorting or having puts on Palantir and Nvidia. These are the most important companies in the market. Quite frankly, you're basically betting against AI if you're betting against what Karp would call chips and ontology, and not just on a philosophical basis, but like Nvidia is 8% of the S&P 500. If you bet against Nvidia, you are betting that the S&P 500 is coming down. Palantir is not 8% of the S&P 500, but Palantir is a massive name in regards to the AI trade. And if Palantir were to go down, you would see probably a lot of other companies fall with it. It is my belief that Palantir and Nvidia are not going to independently fall while the market stays up. I really doubt, given the level of momentum and excitement that is in Palantir and Nvidia, that these two stocks were to go down, if they were to go down 20 to 30%, that the market would still be able to hold up. Like, I just don't see that happening. There are other stocks that can go to zero. The market's not going to care. I don't think Palantir and Nvidia are those names. So essentially what I read from those put positions, if he even has them anymore, is that he's bearish on the broader idea of AI. And then you get this tweet from Burry today, which continues to add fuel to the fire in terms of how he's conceptualizing this idea of being bearish AI. He says, understanding depreciation by extending useful lives of assets artificially boosts earnings, one of the more common frauds of the modern era. Massively ramping capex through purchase of Nvidia chip servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet this is exactly what all the hyperscalers have done. By my estimates, they will underestimate or understate depreciation by 176 billion in 2026 to 2028. By 2028, Oracle will overstate earnings by 27%, Meta by 21%, but it gets worse. More details coming on November 25th. Stay tuned. And he attaches a chart, and that chart is essentially showing the network compute depreciation useful life going into the next 4 years. Essentially, what Burry is stating is that these companies are underestimating the level of depreciation on these Nvidia chips, and that allows them to overestimate the earnings that they have. Because once you take into account all the depreciation of those chips, which is a function of all this capex that these companies are spending, the same capex that is keeping Nvidia at a $5 trillion valuation, then that, in the words of, or in the eyes of Burry, meaningfully deaccelerates earnings and quite frankly overstates what investors are seeing as the perception of earnings. Essentially, he's saying Oracle, Meta, all the hyperscalers are frauding investors by using an accounting trick. I mean, that's objectively what I'm getting from the post. And, he posted it this morning during the market open. Now, when I saw the post, there's two pieces of analysis here. Number one is that Michael Burry has not specifically talked about tickers in the past 2 years. He's very, again, cryptic with the way he posts. He doesn't really post a lot of content. So when he posts Nvidia, Microsoft, Oracle, Meta, like when he's actually posting these tickers, it gets my attention because I'm like, wow, he really wants attention. Michael Burry is someone who can get a lot of attention, given that he was correct about the 2008 housing crisis and called the short correctly and made a lot of money off that. So a lot of people still listen when he says something. He hasn't really used that influence in the past couple of years in the nature of this bull market. The last thing that he said in 2023 was that you should sell in January. Obviously, that didn't really work out. So now he's trying to get some influence. So just from a perceptual perspective, it was very interesting to see that he actually cares about people knowing his thoughts and opinions, aka he wants attention. The sub piece to that sort of macro layer of analysis is that he might be getting desperate. He might be having a massive short or put position that we don't even know about, not even just on Nvidia and Palantir, and he wants more people to know about it so that more people can hop in the trade with him. And he's obviously trying to use his influence to get people to go more in a bearish bet. So that's the first piece of analysis. The second piece of analysis is this whole more to come November 25th. Is he releasing an album or a book? Like, as soon as I saw that in the morning, I was like, what? We're coming out with more information on November 25th. I don't know if there's an earnings report that comes out on that day. We do have Dell earnings. Maybe he's tying something to Dell. I don't know if he's putting out some big article that's going to expose it. I have no idea. In his bio, by the way, the new bio is reactivated here after 2.5 years, something special coming November 25th. I hope it's a book, bro. Because if it's just a book launch, it's like, okay, cool. You're just generating hype for your book. But if he's trying to go super deep into this whole AI is fake thing, I mean, we're going to see what ends up happening. But November 25th, we'll get more details. So what is my takeaway on this? I have not done enough research on the overall CapEx trade. I mean, I've done a decent amount of research, but not enough accounting research to be able to effectively say Michael Burry is wrong about the way he's analyzing depreciation and if that could be overestimating earnings. I will say, even though I have not done all that accounting research, I've done a lot more sort of fundamental research on the nature of like the ROI these companies are getting, the growth rates, how these companies are ultimately thinking of the future trajectory of what their products and services look like. These are public companies that are audited by public accounting firms that have to report to the SEC. So if Microsoft, Meta, Google, Amazon, if all these companies are massively underestimating or under reporting depreciation and overestimating earnings, I mean, like, maybe that's possible, but at its core, I think that's pretty aggressive. And if that were to happen, I don't know if they could legally get away with that. Like it seems like Burry is really grasping for straws here because he's trying to make the argument that like it's all fake. All this capex is stupid. None of it's real. There's no ROI. The data centers are all bubble. He's tweeted some other pictures about how there's all this circular financing going on. And like those are legitimate concerns. I wouldn't say that we shouldn't be skeptical of that stuff. But at its core, he's making the argument that Meta doesn't deserve to be trading. When people say the big tech is cheap, which I've been a fan of saying in terms of just looking at their multiples, and it's hard to say Meta at 19 times earnings is not cheap. Burry's saying essentially they're not trading at 19 times. They're trading at a way more aggressive rate because their earnings are much lower than expected, or at least that Meta is actually showing off. Same thing with Microsoft and Google. So I don't know if he's correct or not. My gut tells me he's not correct, and I think there's a lot more nuance to this. But then again, the reason Burry called the housing crisis was because he was willing to be wrong for a long amount of time until the thesis played out. Now, granted, since then, he is, I think, in my opinion, psychoanalytically, this is my analysis of him, he's been looking for that high. He's been looking for that dopamine. He's been looking to be seen as the guy who called the bubble all over again. It hasn't worked out for the past 15 years. And so I think the guy really wants to be the guy this time in the age of AI, which is why he's bearish Palantir, Nvidia, and using these arguments around capex and valuation. I'm not saying these arguments don't have merit. I do think they're worth looking at, which I will take a deep look at. I just don't know if he's going to be accurate on this. And I don't know if you want to bet against what's going on in AI. Quick example right here. There's a company by Andreessen Horowitz that just got funded, $2.1 billion valuation. The company's called Gamma. Essentially, think of them as AI PowerPoint. That's the easiest way to describe them. PowerPoint redefined in the world of AI. $100 million in annual recurring revenue. They just raised that $2.1 billion in terms of their valuation. So, they're trading at 20 times sales. That's not absolutely egregious. I mean, that's for a startup that's growing as fast as they are, pretty good. And then they have 50 people on their team. So each person is worth $2 million to the company. So like that type of growth, that type of hockey stick level of ARR, and then you look at the valuation, this is not like some $85 billion company. In 2021, we had some stupid NFT and Web3 companies that were worth like $100 billion. This is a $2 billion company, one of the fastest companies to get to 100 million in ARR. And because of AI, they only have 50 people. So the level of efficiency and margins that they have is astronomical. I mean, when you see stuff like this, and the only reason that's happening is because of all this data center spend, all this CapEx spend, all the new models and how they're continuing to get better and better and better. If we get 20 to 30 more of those companies that will become the Googles and Microsofts of one day, hopefully going into the future, I mean, that is what your ROI is going to be looking at, not to mention, the potential ROI that a Gemini, a ChatGPT, and Anthropic are going to be able to create one day. So I think the level of growth we're seeing, the level of spend we're seeing, and the level of transformational impact we're seeing, and we're going to see a lot more of that in the world of FSD, robotics, AI, personal assistants, etc. That is something you don't fade. But Michael Burry seems to fundamentally disagree. And so time will tell, but that is how he's thinking about this AI trade. All right, last thing we got to talk about, stimulus. Trump had a lot of tweets over the weekend and some more tweets this morning. I don't know exactly how to make sense of it, but nonetheless, here's what he said. Lower and middle income USA citizens will receive a $2,000 tariff dividend. That was last night. This morning, all money left over from the $2,000 payments made to low and middle income USA citizens from the massive tariff income pouring into our country from foreign countries will be substantial and will be used to substantially pay down the debt. Thank you for your attention to this matter. So you got a lot of people saying, wait a second, is Donnie T doing stimulus checks again? Because if we're doing STEMI checks again, we got to be going higher, right? We saw what happened in 2020. We got to be going higher if we're doing STEMI checks. Couple points of analysis right here. Basent kind of clarified these comments and said that the $2,000 dividend might be already baked into the big, beautiful bill with no tax on tips, no tax on overtimes, all these other different incentives that the Trump administration is giving to lower and middle income people in the United States. And as a result, that quote unquote 2,000 dividend might not actually be a full on stimulus check. So that's the first piece of analysis. Trump then doubled down on the statement today by putting out that 2,000 dividend tweet, which got a lot of people to think, okay, so if you give it to 200 million people, exclude 100 million for the income stuff, which would be like 75,000 for single people and 150,000 for couples, you're printing about $400 billion. If you're printing about $400 billion, well, we're only bringing in about 300 billion from the tariffs. So like, how does any of this make? Even if you give, okay, so let's give all the money away from the tariffs, 300 billion, that means we have 100 billion left. That means we have to print it. What does that mean for inflation? What does that mean for asset prices? What happens to the economy when everyone gets a $2,000 check and they buy a new laptop? How does that inflate earnings? I mean, there's so much stuff to kind of think about from a macro perspective. I don't actually believe we're going to be printing $2,000 stimulus checks. I don't even think Trump has the authority to do that. I think you need Congress to agree, and I don't think there's any chance in hell Congress is going to agree to be able to give a $2,000 stimulus check to people, given we saw the types of inflation that happened last time when we enacted that. But it's a new topic that Trump's been talking about, and I think the number one reason he's been talking about it is because there's been a lot more questions ever since the Mamdani election in New York City around affordability. And I'm very curious to see what people think in the comments on, like, do you think this country, at least if you're in the United States, is affordable? And if you're not watching from the United States, I'm still curious to hear what you think, because across the entire world, it seems like this conversation around affordability is getting more momentum. Now, from my understanding, covering the 2024 election, affordability was not the main concern. Honestly, the main concern, if gun to my head, what was the number one thing that I thought the 2024 election consisted of? Immigration. I thought that was the biggest thing that people cared about. And now with this Mamdani election, and you got Democrats winning other states in the country, it's almost like the concept of affordability, and maybe that's because prices are up, certain things are down year to date, like egg prices. Other things are up, like general grocery prices. And every time, Trump is asked about this, he doesn't really have the best answer for it. And quite frankly, he might not be able to give the best answer because the administration did not really focus fully on affordability. They focused on tariff revenue. and they focused on getting these trade deals with all these other countries, which, by the way, one can make an argument was very important. Like being able to get the EU to give us $750 billion for gas and getting Japan and South Korea to commit to $500 billion of investments, like all that money coming into the ecosystem, getting the Saudis to buy trillions of dollars worth of chips, that stuff really matters. And I think the way that Trump is kind of framing the narrative right now is that the tariffs are so important from a national security perspective, which, by the way, I agree with. I mean, like, we got to be able to build our own chips in the United States. Jensen agrees with this as well. We got to be able to build our own pharmaceutical stuff. So, like, one could argue if we were to get into a world war tomorrow and we can't build our own chips, have our own pharma, have our own supply chain, that stuff really does matter. However, the trade-off potentially might be affordability, or at least the lack of care of affordability, and also the potential of inflation rising because of the tariffs, which makes things even more unaffordable. Not to mention, in the world of AI, we're having all these layoffs in terms of cracks in the labor market, the lack of employment opportunities because there's not that much of a chance to find a job, or at least anecdotally, that's what I've been hearing. And I'm curious what people are hearing as well, that jobs are not the easiest to find right now. And then AI being a catalyst for more layoffs. Now you've got a real unaffordability crisis coming on because people, don't have jobs. And if they don't have jobs, they don't have the money to be able to spend on goods and services, which ultimately could affect the economy. So who has benefited over the past 9 months? Asset holders, people like you and I that are watching this video right now. If you've bought stocks, you've done very well. Nvidia's done very well. But the bifurcation of this economy of Nvidia shareholders doing well, and then someone who's working a 9 to 5 that just got laid off, even if they're not even a blue collar worker because of AI, exactly what Nvidia is working on, that creates a lot of difficult conversations to be able to have as a president. And so I think what's going on with Trump right now, not to mention, here's the final nail in the coffin, the Supreme Court, from what I've been reading, might strike down this Trump tariff case. I don't know if it's going to happen, but from what I've been reading, Supreme Court's not feeling that friendly against the constitutionality of the tariffs. If they were to strike down the tariff case and have to force Trump to reverse everything, which I don't even want to imagine what that would look like, and you've got this broader argument around affordability not necessarily being the center of the Trump campaign. They're more concerned about tariffs and investments and revenue, and the American people feel that affordability is not being discussed enough. And if things are generally becoming more unaffordable, you got Trump talking about 50-year mortgages over the weekend, potentially 15-year car loans. Obviously, it's not even political to say this. Objectively, Trump is trying to figure out how to make things more affordable, and he's responding to the chatter in the mainstream around a lack of affordability. Obviously, interest rates have not come down as aggressively, and so you've got Trump that's trying to figure out how can we frame the narrative in a way that is more helpful for the average American citizen that can't afford a car, a house, groceries, etc. I don't know what that results in. I don't know if that hurts Wall Street in 2026, because so far that hasn't really hurt Wall Street. But I think it's something we all got to care about, and we all have to pay attention to in regards to the labor market, because if that does begin to crack in a meaningful way, which theoretically could create a lot of deflation, you have AI creating deflation, which means maybe if you did print $400 billion, it wouldn't be that inflationary, although my gut tells me it's probably going to be more inflationary than not. If that does end up hurting the broader economy, that's obviously going to affect Wall Street, and that's obviously going to affect asset prices. So it's something that we have to keep an eye on. I'm trying to do as much due diligence as I can to really understand what's going on in the labor market. Chipotle, Lululemon, all these stocks that have got hit this year because they are consumer-oriented brands that are seeing a decline in the strength of the consumer. But then you have Uber and Affirm say that the consumer is fine. I mean, there's a lot of mixed data. I'm trying to put it together, but at its core, it's something that we can't forget about. And it definitely is probably influencing the whole idea of a $2,000 tariff dividend, or at least Trump trying to make the argument that, this administration is focused on affordability and trying to help the everyday average American to be able to continue to afford things in society. All right, that's it for me. Thank you, everybody, for listening and watching. Appreciate everyone being part of the show. Daily recaps are back Monday through Thursday. We'll be here every single day around 8:30 p.m. Eastern, and I'll see you guys on the next one. Thank you, everybody.